Every single day, forces you've probably never even heard of are moving your money. I'm talking about the Fed, AI, geopolitics, currency wars. Look, most people only see the headlines, right? But they never actually understand the signal beneath the noise. That is exactly what MacroSignal is for. Back in December 2007, most Americans had absolutely no idea a recession had already started. By the time it was officially declared in September 2008, which was 9 whole months later, the stock market had plummeted 40%. The people who saw it coming, the ones who understood the signals hidden in the data, they protected themselves. The people who didn't, well, they didn't. And the difference wasn't about who was smarter. It was just about knowing exactly where to look. So in today's explainer, I'm going to show you exactly where to look.
You see, understanding the actual mechanics of the economy is really the only reliable way to shield your portfolio from sudden, massive shocks. We are constantly, and I mean constantly, bombarded with economic noise. But the true health of the economy, that's written in a language of leading indicators. If you can learn to read that language, you stop being just a victim of circumstance, and you start becoming the architect of your own financial defense.
Okay, let's dive into this number right here. $11 trillion. Let that sink in for a second. That is the staggering amount of household wealth that just evaporated during the 2008 financial crisis. And why did that happen? Because millions of retail investors just sat around and waited for an official government agency to announce that, yes, we were in fact in a recession. By the time that official word finally came down from the mountaintop, people's portfolios were already completely decimated. So the absolute crucial takeaway here is that relying on official declarations to protect your money is a losing game, period.
Which brings us to Section 1, defining a recession, and exactly why waiting for the official word is way too late.
To actually protect ourselves, we first need to understand the rules of the game we're playing. Let's look at how the powers that be officially define a recession. More importantly, let's look at why their timeline is so incredibly dangerous for your wealth. So in the US, the official economic scorekeeper is the National Bureau of Economic Research, or the NBER. They define a recession as a significant decline in economic activity that is spread across the economy and lasts more than a few months. I mean, it sounds super straightforward, right? But the devil is totally in the details of how they actually measure that decline.
The NBER relies on this criteria known as the 3 Ds: depth, diffusion, and duration. Basically, they're looking at how deep a downturn is, how widely it's spread across various industries, and how long it lasts. Sounds logical? But here is the massive catch. These 3 criteria are entirely interchangeable. Take the February 2020 crash, for instance. The economic drop was so incredibly deep and so widely diffused that the NBER declared it a recession almost instantly, even though it was literally the shortest one on record, bottoming out just 2 months later in April. So extreme depth completely offset a super brief duration.
But here is the fatal flaw for you and me as investors. The NBR's approach is 100% retrospective. They wait until they have absolute ironclad certainty to declare a peak or a trough. Guys, they are historians, not forecasters. They wait months, sometimes closer to a full year, to look back and say, yep, hey, that was a recession. If you are actively managing your own portfolio, waiting for historians to tell you your house is currently on fire means you are going to burn. You have to be able to smell the smoke. All right, let's get into how we actually do that. Signal 1, the yield curve. This is all about reading the barometer of time and risk. So, how exactly do we smell the smoke before the fire? Well, we look at the exact same data the big institutions look at. Think of the yield curve like a weather barometer. A barometer doesn't tell you it's raining right this second. It measures atmospheric pressure to tell you a nasty storm is brewing. Let's use a quick analogy. In a normal, healthy economy, time basically equals risk. If you lend someone money for 10 years, you're going to demand a higher interest rate than if you lent it to them for just 2 years, right? Because a lot more can go wrong over a whole decade. Makes total sense. But in an inverted economy, that logic completely flips upside down. Investors get so panicked about the near-term future that they actually demand higher interest rates for a 2-year loan than a 10-year loan. When the short term gets completely disconnected from long-term reality like that, the system is breaking. And this right here brilliantly illustrates what that looks like in the real world. This is data straight from the St. Louis Fed, tracking the spread between the 10-year and 2-year Treasury yields. See that black line sitting right at 0? That is our threshold. Whenever the blue line dips below that black line, boom, the yield curve has officially inverted. Short-term rates are now higher than long-term rates. Now notice those vertical gray shaded bars?
Those represent official U.S. recessions. Historically speaking, almost every single time this blue line plunges below zero, a gray bar follows shortly after. It is quite literally one of the most reliable alarm bells in modern finance. Moving on to signal 2, junk bonds, or as I like to call it, visualizing pure corporate panic. Now, we never ever rely on just one single signal. We always need confirmation. If the yield curve measures systemic overall pressure, junk bond spreads measure pure, unfiltered corporate panic. Just imagine a bank is lending money to a borrower who has a terrible credit score. Normally, they might charge, say, a 5% premium for taking on that risk. But suddenly, overnight, the bank demands a 15% premium. Why? Because they are absolutely terrified that the borrower is about to lose their job and default. That's exactly what this chart is showing us, just on a massive corporate scale. This is the ICE BOFA U.S. high-yield option-adjusted spread. Just look at how violently that blue line spikes upward right around those gray recessionary periods. Let's quickly break down what's actually inside that index to see why it reacts so aggressively. This tracks what we colloquially refer to as junk bonds. This is debt from companies that are rated below investment grade with at least $100 million outstanding. Because these companies are already financially fragile, they are always the very first to feel the squeeze when the economy starts slowing down. When lenders get scared of an impending crash, they instantly demand massive interest rate premiums to hold this incredibly risky debt. So when you see high-yield spread spiking, it means the smart money is fleeing to safety and bracing for impact. Which brings us to signal 3, the LEI, the economy's ultimate check engine light. So we have our barometer and we have our measure of corporate panic. But what about the actual physical economy happening on the ground? Enter the leading economic index, or LEI, published by the Conference Board. If the NBER is that historian looking squarely in the rearview mirror, the LEI is the check engine light glowing on your dashboard, specifically designed to anticipate major turning points by around 7 months. The real beauty of the LEI is that it isn't just one random data point. It's an aggregate of 10 highly sensitive metrics. It tracks things like average weekly hours in manufacturing, initial jobless claims, new orders for consumer goods, building permits, S&P 500 stock prices, and even consumer expectations. By combining all these independent indicators together, it strips out the random noise of any single sector and reveals the true underlying trajectory of the entire economy. Look at the absolutely stark contrast revealed in this data from the Conference Board ending in April 2026. The coincident index, which measures the current state of the economy, that was actually up 0.8% over the prior 6 months. The lagging index, which looks at the past, was also up 0.8%. Honestly, if you only looked at current or past data, you'd think everything was perfectly fine. But look at the LEI, the leading index. It contracted by 0.7%. Even with all that surface-level strength right now, the leading indicators are screaming that highly fragile economic conditions are ahead, eroding purchasing power and signaling potential weakness. The check engine light is glowing bright red. All right, let's tie it all together. The signal beneath the noise, protecting your portfolio. We've looked at the yield curve, corporate credit spreads, and the leading economic index. And I want to be clear, these aren't just abstract charts on a screen for academics to debate. They're the actual mechanics of the financial machine. Let's pull all of this together into a concrete action plan for weathering the storm. Number 1, track that yield curve. If short-term rates eclipse long-term rates, the countdown clock has officially started. Number 2, watch high-yield spreads. If they start spiking violently, that tells you corporate credit is freezing up out of pure fear. And number 3, monitor the LEI. If the leading indicators are contracting while coincident indicators are still positive, you know a systemic slowdown is likely just months away. That gives you the precious time you need to adjust your portfolio before the masses even catch on. Look, the NBER is going to tell you a recession happened long after the damage is already done to your wealth. But the data absolutely does not lie, and it definitely doesn't wait around for a press release. The signals are always there, buried just beneath the noise, moving your money every single day. The macroeconomic data is flashing. The real question is, are you watching?